Tom, thank you so much for being here. It's been a pretty active week for the commodities market, I suppose, largely driven by what's going on in energy after we had the OPEC announcement from over the weekend. What do you forecast for oil prices here going forward?
Yeah, there's nothing like an OPEC meeting to get everybody excited about oil prices. What we're seeing is that the near-month futures for crude oil are up way above the further out months, and that's indicative of a short-term supply squeeze, and it puts the futures market into a condition known as backwardation, which is the opposite of the other jazzy word contango. In backwardation, the near price is higher than the far price, and that's a lot harder to recover from. When you're in contango, you can see silly things like people buying spot crude and renting a tanker to store it offshore for a few months so that they can take advantage of the price spread. Can't do that in backwardation. All you can do is try to produce your way out of it. And when you see a high backwardation like we're seeing right now, that's an indication that the near-month price is at a top. People are not, in the futures market, are further out, are not believing in the idea that the current price is a legitimate one. And that's also explains why you're seeing crude oil futures prices in the near month continuing higher, but oil stocks are not. The oil stock analysts and traders are looking at the rest of the curve, and they're saying, yeah, it's great to be selling crude oil prices at $74 in the near month, but you're not getting that much further out, and that affects the earnings prospects. And so that explains some of the difference between the oil stocks and the commodity itself.
And obviously there's a lot of interrelatedness between a lot of the commodities, of course, but you really watch the moves in gold and believe that that portends what will happen in the oil market. What is the gold market telling you now?
Well, gold prices, the movements of gold prices lead similar movements of a lot of things. The correlation with oil this year has not been as good as it has been historically, but the correlation between gold forward and interest rates has been just doing great. I forwarded a chart to your folks comparing the gold price shifted forward 20 and a half months to interest rates. And this only shows a small segment of time. It's been working a lot longer than this. The drop in interest rates that we've been seeing that's been getting a lot of attention, you know, we got the 30-year down below 2% again. Mortgage brokers are going crazy trying to get refinances done. This is all normal, and this is all exactly as gold told us would happen when gold had a small pullback 20 to 21 months ago. We're just echoing that small pullback in gold prices 20 and a half months ago. And we have a major inflection point coming up at the end of July when yields should bottom, meaning bond prices should top. And we see a big up move in bond yields going into the rest of 2021 through all of 2022. Remember, gold topped out above 2,000. That's not even reflected on this chart because I chopped off the right side of it. So interest rates are going to have to do the echo of that big uptrend in gold prices from 1,400 to 2,000. We got a big increase in interest rates that's coming, but not until the start of that point of that is it due at the end of July.
What about the S&P 500, Tom? Is it going to keep making new record highs throughout the summer?
For a little while longer, Wilfred. We all have been trained that we're supposed to sell in May and go away because the normal seasonal factors say you're supposed to have a top in May and sideways to down. But the first year of a presidential term is different, and that's why we look at the presidential cycle pattern, which treats seasonality of the years differently. What you're seeing right now is a comparison of the S&P 500 to how the stock market behaves in the first year of a presidential term. And rather than topping in May, it's normal to top in July. Ideally, July 19th. Ideally, but take that with a grain of salt, plus or minus a few days either way. There's another top due at the beginning of August, pretty much co-equal in terms of what the pattern says. How real life turns out is going to be a little bit different. And remember, the Fed is providing a tailwind to the market with QE that they're not even talking about tapering yet. So that's going to tilt the slope upward. But I do expect an important inflection point due next week to the week after, ideally July 19th, when everybody will be talking about how the QE is going to keep on going and the uptrend is going to keep on going forever. And what are you doing getting out of stocks? So don't be a fool. Don't miss out. When everybody's talking about that and they're only giving you upside projections, that's when you know the top is near. Just as you know that when everybody's giving you downside projections and it's all going to, and the sky is falling and we're all going to die, you're near the bottom. We're getting close to a top. We're not there today, but today's a good effort to try to get prices up a little bit further toward that.
Shepard Smith here. Thanks for watching CNBC. on YouTube.